Good evening to all. Today is the fourth study circle meeting for the year. We have two topics for the day. First one is on GST. This is the third part of the lecture for the series by Mr. T.R. Srinivasan, taxable persons and on taxable person registration. The second topic for the day is on by Sri Lakshmi Valli Advocate, overview of DTAA's post-MLI. I think for those who are not aware of Mr. T.R. Srinivasan, I'll give a brief introduction. Mr. T.R. Srinivasan is a chartered accountant. He is a fellow member of the Institute of Chartered Accountants of India for the past 13 years and he is an insolvency resolution professional. He is a partner of N.V. Balaji & Co. Chartered Accountants, focusing on matters related to risk advisory, goods and service tax, customs and foreign trade policy. He is a member of the study group for implementation of GST in ICAI, a certified trainer of NASAN, Government of India for GST. He is a trainer for the Officers of Income Tax, GST, Customs and CNAG. And he is All India rank holder at ICAI and gold medalist in BCom. We have the right person to educate us on GST over the year. I hand it over to Ms. T.R. Srinivasan.
Thank you, Vasu sir, and also RBA for the opportunity to share my thoughts. So just directly, some of the questions online to offline, there is a lot of difference. So probably we thought we'll make this more interactive. So of course the topic is GST. I always tell that other than father, mother and close friends, GST is the one which travels with us every day from morning to night, from birth to death. So in fact, recently of course government had clarified that burial, crematorium and all exempt from GST. So otherwise, birth certificate exempt, death certificate exempts. Everything else, it's like in LIC they used to give one in advertisement. In Tamil they used to say வாழும்போதும் வாழ்க்கைக்கு பிறகும். Like that GST is வாழும்போதும் always there. At least வாழ்க்கைக்கு பிறகும் it's not given for now. But probably we may have few judgments coming in later point in time about recovery, etc. that may help those things. So to start with, basic question is who has to pay GST is a question which we are going to address today. Let's not make it theoretical, but let us have a conversation whether, because of course this is primarily, we have a lot of advocates here, so whether advocates should pay GST or not. That whether should we register and pay GST under the not required. So advocates are not required to pay GST. So I mean, if you have
any other income apart from like some rentals, etc., club together with your income, if your exceeds threshold, then advocate need to register and.
So to put your explanation into example, let's say an advocate earns about 1 crore, no GST per se. I mean, advocates have, from GST perspective, advocates' incomes are grouped into two categories. Those incomes for which there is no GST at all, means exempt by a notification. To simplify that, it's very simply whatever we do B2C, other than business related litigations, they are all exempt from GST. In a very, very simplified understanding way, whatever we do B2C consulting, where the end beneficiary or the litigant petition, whoever happens to be a individual who is not into business, basically it's not a business related issue, then it is exempt. The other aspect is whatever is provided to a business entity is taxable. Okay, there's no exemption for it. It is taxable. But the only thing is that it is taxable in the hands of the person who is receiving the service. Basically, we call in GST as the word reverse charge. But from GST perspective, it is treated as exempt in a different context altogether. So both categories we can say. So end of the day, advocates are not required to register. That's a specific provision. If you see the law, it says any taxable services, or in fact, it says aggregate turnover more than 20 lakhs, you have to register. That's all. It doesn't distinguish between whether it is under RCM or reverse charge or forward charge, whether you are liable to pay or customer is liable to pay. Those is not the distinction. If aggregate turnover crosses 20 lakhs, we are required to register. The only relaxation is if whose services are exclusively under reverse charge, then they need not register. So as sir was pointing out, let's say our advocate fees is 30 lakhs. We earn 30 lakhs or 1 crore, whatever, no GST. No need to register also. But however, let's say I received 1 rupee of rental income, or I receive 1 rupee of the other non-advocate income, let's say consulting, business income or something. In which case, I am required to register. So even if I receive, let's say 1 crore and 1 rupee happens to be my rental income, I am required to register. So the 20 lakhs calculation is not for my non-advocate services. It is my total turnover, which includes RCM invoices as well as regular invoices also put together. So probably, in fact, last few months back, we had a lot of notices being served by the GST department under erstwhile service tax law to the advocates to register. Of course, the courts also came back very strongly, quashing all those notices. Because in service tax law, the background is different. Whereas in GST, what we are looking at is an aggregate turnover. And the word aggregate turnover is very wide. So it means that to say that renting itself, commercial property, residential property is exempt again. So if I have 1 rupee of any other income other than my advocate source of income, and that becomes liable for GST, it means advocates have to register. So to put it in a very simple way. So this is the power, the scope of registration is given this way. Now the second issue is coming from here, because advocates are not required to register, or advocates are paying GST indirectly, in the sense the customer is going to pay GST to the government for our services, if it's going to be a business nature. So the service is taxable. We are only not paying. That's the only thing. Let's say in my office I buy a printer, computer, I buy whatever equipments. I do an interior for my office, for the advocate's office. Or there are so many expenses we may incur, and that may also have a GST cost. If it is from registered persons, it may have a GST cost attached to that. So what happens to all the GST which the advocates pay on their expenses? Can you tell me? What happens to the GST paid by advocates? So as a chartered accountant, if I pay, so in our office we have two offices. One is a CA office, another is an advocate office is there. So whatever the CA office incurs, we are anyway charging to my customer, and I take credit for that and is adjusted. For an advocate office, all these expenses which I am going to pay, what happens to those expenses? It adds to my cost only. Because there's a specific provision which says, to make an example very simple, an advocate providing services to a company is still paying GST for it. There is no revenue loss to government per se as regards the service is concerned. Just that they have put the responsibility on the recipient to pay. But can the advocate take credit for it? The answer is no. So what is happening is, the government has created, I thought this could be the forum to present this as a proposition that the service is taxable per se. However, though being a taxable service, the credit has been disallowed by way of a separate section. So to put it, section 16 talks about eligibility to credit. So everybody who is into business can take credit, provided they have a taxable outward supply. Advocates also have taxable outward supply only. But by section 17, what they have done is through explanation to the section in section 17.2, they clarified that services under reverse charge mechanisms are deemed as exempt supply for the purpose of eligibility to input credit. That means as regards input credit is concerned, RCM related services are deemed as exempt. So it means a CA having credit output is very much okay because I have outputs and input. Whereas an advocate having an output and input, the input is not eligible for credit. So indirectly there is a cascading effect to that extent. Only for those people who are having a big setup and having offices and having expenses, etc. So in fact, we also internally discussed, is it a reasonable classification? Does it fall under Article 14 as a reasonable classification to justify that whether distinction is permitted? Or is it an unreasonable classification? Because to put the context fully, the erstwhile law, when we had service tax law and we used to have CENVAT credit rules. Most of you must be aware of the CENVAT credit rules. In CENVAT credit rules, the provision was different. There, the government said, even there also advocate services was under reverse charge only. So for all those reverse charge services, the government gave an enablement for refund of that credit to the recipient. So the taxpayers who are under reverse charge in the erstwhile law were eligible for refund of credit. There is a specific rule, 6B, which was talking about refund of credit. So it was not a cost, even in the erstwhile CENVAT credit rules. Now post GST regime, this has been treated as a cost. So this is probably coming from the fact that advocates are not registered under GST because of the law says so. Right. Now the next question is, I would like to charge GST and collect it and pay. Is that okay? Like myself voluntarily register it. Can I collect GST on a transaction which is under a reverse charge? What is your view on this? These are all purely, we are not having any precedents, nothing, because GST is absolutely fresh. Okay. Can I collect something on a transaction which is under reverse charge, which I am not required to pay? Not possible. So there is a section 11 which talks about exemption only. It doesn't talk about reverse charge, where it says that an exempt transaction we are not supposed to collect and pay to the government, because earlier in the old law what used to happen is, even for exempt people used to collect and pay. Advantages, they will take input credit for the same, whereas in GST they wanted to in fact then the government amended the law and said for an exempt transaction do not charge. It's treated as now an offense to do the same. It has been clarified, penalty corresponding provisions are there. So the same provision, of course, for an exempt for a transaction is under reverse charge, there is no express provision debarring the same. Let me also put the context. There is no provision which says you should not charge. In fact, practically speaking, what happens is, let's say a transaction was under reverse charge, the recipient is supposed to pay, and for various reasons recipient has not discharged the liability. Departments have taken a practical view where they said, if the supplier has charged GST and paid to the government, you produce the challan and that will be considered as compliance of the provisions of the law. So there had been precedents where it had been allowed. There was no express provision which says the recipient should not collect and pay to the government. The law only mandates there's no expression which says the supplier should not collect and pay. The law only mandates the recipient should pay. Correct. The law does not say, as regards exempt, it is there. You should not collect and pay. And definition of exempt does not conclude reverse charge also. I mean, these are all open points, but all these are related to the fact that advocates are not registered under GST. Right. So now I'm just, I didn't go specific to the provisions. I thought I'll make this more relevant to the profession, to us, so that probably, in fact, there I believe there is a writ petition already filed challenging the section 17, which treats the reverse charge persons in a manner different from normal persons, because both are taxable only. Because of reverse charge, you cannot say credit cannot be allowed. So that is a provision. In fact, in all other instances, there are so many cases of reverse charge. When I say reverse charge, supplier is not liable, customer is liable. There are multiple instances. We have, transport agencies under reverse charge. we have reverse charge means customer, again, there are certain banking recovery agents are there who are under reverse charge. The banks, basically, wherever the supplier seems to be unorganized, or there is resistance from supplier. Let me also put the other situation where there is a resistance from the supplier. Most of those occasions have been under reverse. That could be the policy of the government per se. I'm not trying to mean that these are the situations, but these are all. See, originally transporters were under forward charge, but after so much of protest, it became a reverse charge. So there had been situations like that. So because of this, there is a distinction between even those cases to the advocate situation, because of the fact that transport agencies also now brought. Now I'll tell you the shift in the government's policy. Now the government has started giving options for every services. You have an option either to go for forward charge or reverse charge. For example, transport agencies, they have now brought, if you are a transporter, as a supplier, if you would like to pay GST, please register yourself and charge 12% from your customer, take input credit and pay the net amount to the government. If you are not opting for forward charge, then you don't register yourself, let your recipient pay 5% and matter is over, you don't take any credit. So they have started giving options even for other services. For example, they are now started bringing, this is after a lot of representations have gone to the government from the transport associations, etc., that, give us an option. Why don't you yourself decide? See, it's a situation where you put myself under reverse charge and say I don't take credit also. So you are putting a restriction on both the sides, which probably defeats the underlying purpose of GST to the extent of cascading effect, because recipient will pay to the government and I also don't take credit. So what happens? There is the value chain is blocked to this extent. So this is the proposition which probably is relevant to the topic of registration. I didn't open the next slide, but then this is what we are looking at as regards registration per se is concerned. So law says 20 lakhs you cross, you register it. Now the 20 lakhs, they have said even if you do 19 lakh 99,999 exempt, 1 rupee taxable, you still have to register and pay GST only on the 1 rupee, not on the 19 lakh 19. You pay GST on the 1, but you will have to go through the process of compliances of registration, filing returns, etc. will come. Now it says where you should register. I mean, these are all the potential litigations which have started coming out. Very interestingly, a few days back I was addressing a session for the treasury's offices, all the accounts offices of the government department. We had excellent discussion, I would say very, very live discussions. Prisoner cells, now they started manufacturing, they still lot of products manufactured by the prison. Tamil Nadu prison started it probably a few years back. The question was, sir, I have done 4 crores of sales in the prison. I mean, not in prison, using the prison. We asked at least whether it's an handicraft. They said, no, we use a machine-made products and we are selling it. The question is, should I register under the GST law? I'm just putting questions. They are not registered, by the way. Okay, potential litigation coming up there. The next question they asked, archaeology department. Very interesting question. And by the way, I'll come to the last question, which has come from Madras High Court itself. So archaeology department, they said, sir, our main objective is not to collect anything, but then we used to maintain these museums and we collect entry collection fee of 20 rupees per 20, 30 rupees, etc. And it has crossed 20 lakhs in a year. Should I register? Third scenario, I'm just throwing situations, you can make your own conclusions. I'll put the context also, some basis of decision also. The third situation was coming from Raj Bhavan, okay, governor's office. So the question is, sir, governor, expenses are there, governor house. Raj Bhavan is basically governor's household expenses. It's a personal expense of the governor, but of course, managed by defrayed from the government kitty. So the question is, for government agencies, apart from the regular registration, they also have to take a registration for a TDS purposes, just like income tax TDS. GST also has TDS. That is primarily because many government contractors, there have been defaults with respect to the payments to GST. So the government has introduced a concept of TDS under GST also. That means if you are supplying to government, the government people has to register themselves and deduct TDS under the GST law also, just like TAN. With TAN number, they'll get a GST TAN number and deduct TDS. So governor's office has not been registered for even for the purpose of deducting TDS. So the interesting question is, sir, governor, what happened, purchased, governor means governor's office has purchased provisions for 2.5 lakhs. There's a limit of 2.5 lakhs. More than 2.5 lakhs means this TDS has to be deducted. So they said they purchased various provision items like rice, so many items, masala items, all the items, which is for conducting functions at the governor's office. He hosts lot of functions. There are other remarks, but then I'm not getting into that. So he hosts lot of functions. So the governor's expenses. Should I deduct TDS? Am I required to register as a TDS deductor and deduct TDS for it? Because one or two bills crossed 2.5 lakhs limit for that bill, per bill 2.5 lakhs. So in that bill, some bills will be taxable, some bills will be exempt. For example, rice, unbranded rice is, or unpacked rice is exempt. Meat exempt. So like that, some are exempt, some are tax. Masalas taxable at 5%. So how do I at all decide should I register or not? They have not registered. After the discussions, they thought they should register and comply. So they are supposed to comply actually. The next question was coming from I and PR department, that is Information and Public Relations department. Question is, sir, we have so many locations maintained, Gandhi Memorial, Kamara, like that. All these memorials we only maintain. In these memorials, we allow private people to have photo shoots. Should I register? They are required to. But one thing is, of course, in those cases when they supply to business people are required to register and pay RCM, reverse charge is there for them alone. So that is in a way not required to register, but I'm saying the scenarios which are coming up are quite unique, and even government would not have thought that these could be the ramifications of the GST, because these things the government has thought they have given some exemption. I show you exemption where they specifically told issue of birth certificate exempt, issue of death certificate exempt, income tax is exempt, like that and all is there, exemption specifically. But there are so many other things which even we cannot visualize. So they started bringing about. The next question was from Madras High Court officers, not from the court, but say officers. They got a C&AG, AG audit is there. There's a resident AG department is there in the Madras High Court, which normally reviews the accounting side of things, not on the other side, accounting side. So they raised a query. The query they raised is, sir, you are paying money out of the government's. I told the context. More than 2.5 lakhs, if any government agency pays to any person, they have to deduct TDS under GST law also. So the question is, High Court has subscribed for so many softwares, like you have so many tax softwares, so many like for accessing the judgments, precedents. They all easily will cross 2.5 lakhs subscription fee. But High Court has not deducted GST TDS. You have not deducted TDS under GST. Please clarify. This is the question raised from AG department to the registry of High Court. Probably, somebody from their offices, they forwarded the query to us, like they wanted a response to the query. Now, please, now you can share your thoughts. Do you think High Court of Madras should register and deduct TDS? Huh? No, let's for a fact assume there is no exemption at all. I've given you the sufficient facts of the case. Background, legal provisions, whatever I've told till now is there. There is no exemption at all as regards this particular activity is concerned. The question is whether High Court of Madras is required to register and deduct TDS under the law. Excellent.
Will it apply for official liquidator as well as official assignee?
Yeah, official liquidator is a court appointed or NCLT appointed. But you are going to function as a custodian of that particular company only, right? You are not an independent person. Personally, you may not be liable, but then as a custodian of the company's representative, you are liable. Yeah. So now question is this. Sir has given one answer. Any other further inputs? As a person, they should all be. So to put the simple understanding, government and government, no exemption into that. There is a general assumption, even in my own office, who are already into GST probably for 1 or 2 years. The moment we say government, they think, it is exempt. But it's not. No government or a government agency is exempt unless specifically mentioned so. Okay. That's what I gave you examples now. So many situations, very unique. So there are some more, but considering the time, I'm not specifically discussing. Now coming to this discussion, any other inputs you would like to add? We'll have to clarify to the High Court also. Should it be see, High Court means not High Court per se, but I'm saying the officials who manage the functions, that's all. The registry has forwarded. Sir has given an input that High Court is not, so the first thing is, who is liable to register and deduct TDS is a government and government agency is the definition. Government and government agency is the definition. So the C&AG is saying that you are required to register and deduct. It means they are saying High Court per se, or rather not High Court, but the functions, administrative functions of the High Court is either a government or a government agency. That's what they are trying to communicate. So Sir is told that it is never a government. It's an independent body. It's a judicial authority, is separate. Okay. But the AG's view is you are getting the money from the government only. That's the AG's view. But still, it's not over. I am not given my thought process. What is your view? Ah.
It's not subject to service tax.
No, even that point, they are not told it's not subject. They only said it is treated as a government authority. Okay. There was no exemption given. There's exemptions only for filing some returns. But taxability is, so we are not talking about the taxability per se. Not of the income earned by High Court. High Court earns incomes through fees, etc. They are all exempt. We are now looking at a situation whether High Court is required to register and deduct TDS compliances under the law. Let's say income tax. Is High Court required to register and deduct TDS under income tax? Let's leave the GST per se. I'm talking about GST because this query has come specifically on GST. What are you talking about? Income tax.
What's your view? Department view?
The official trustees and other things, they are just filing the return, but TDS is also deducted, is my view.
So,
He is asking
High Court.
Income means to the staff.
And not just High Court, any judicial body.
No judicial body is taxable.
On the income side, absolutely we agree. I'm talking about on the payments they do.
Suppose they make the payment to the staff.
Yeah, payments to the staff or payments to the vendors, 192, 190.
TDS is responsible to deduct the TDS. The principal officer of the High Court, he should deduct the TDS on salary disbursement, other disbursement. If it is applicable, it's very simple.
Okay. 192. For all other payments, 193, 190. I don't know. Don't think I know the answer. I don't know the answer. I'm just asking you the question.
Principal officer is liable.
Liable to. So under 194J, whatever it is, we are looking at any person. Is that right? And any person includes judicial bodies also. Is that the understanding, right, sir? Okay. So as regards, okay, I repeat, that is, I have not concluded anything. I have just left it to you for further discussions among yourself. My question is, because the person definition don't think includes High Court or AOP or BOI. High Court is never AOP, High Court is never a BOI. High Court is definitely not government. Okay. So that's the point I am coming to. As Sir was pointing out, the expenses of the High Court is, High Court or Supreme Court, whichever it is constitutionally mandated to be borne by the respective state government or the central government. It's a constitutional mandate to defray the expenses. That is, the C&AG is an independent body. The government cannot go and interfere on the decision making of the particular expense. That is, the registrar or the respective district registrar gives the budget of my expenses. What is my plan? What is my expansion plan? What is my expenses? That budget presents to the government. Government decides how much they can elect based on the funding position of the government, and that gets approved. And after that, the further decision of payments, responsibilities for accountability, everything lies with the independent functions of the officers. And more importantly, some of the roles appointed is not under the government rules. It is coming under the separate service appointment rules are there as regards the High Court functions are concerned. In fact, that I believe registry is also a district judge only is qualified to be the same. Maybe you can correct me if I am wrong. That's what the research they could able to do. It's only a district judge can be a registry. So it means with all these facts, High Court can never be a government or a government agency. Though they draw the money from government, that per se will not decide that they are a government or government agency. Hence we had concluded you are not required to deduct TDS. But whether they proceeded with that or they decided to comply is another issue. Like they wanted to pay the tax of another issue. But then in principle they do not come. But vis-a-vis the income tax, whether you are required to deduct, now that is for you to, that is for separate discussions to happen in this regard. But registration word GST itself is very powerful. That's what I was trying to communicate. Whether a person is required to register or not itself we are not coming. What we are looking at is they should do business and their aggregate turnover should cross 20 lakhs or traders or manufacturers is 40 lakhs. Service providers means 20 lakhs. If somebody does both service and manufacturing, then again it is only 20 lakhs. So basically exclusively traders manufacturers is 40. And this 20 lakhs or 40 lakhs, how do we calculate? It's a very interesting question. So they say the aggregate turnover, the total turnover. I'm not getting into the wordings, I'll give example to explain. Let's say in a business, you have a business per se, like a chartered accountant. He earns professional fees of 19,50,000 rupees. And he earned renting of residential property. Renting of residential property, which is about 1 lakh. Okay, residential property, nobody pays GST. Am I right? We are not paying any GST on the rent which we pay to, if we are in rented premises, or we are not paying GST on our rental income also. But for calculation of GST turnover, it says you have to include all taxable supplies. It also says you have to include all your exempt supplies also. That is, even if it is exempt under GST, you have to consider for the calculation. So that means a hospital, they may be doing 100 crore, no GST if it is healthcare, that is exempt. But if they earn, let's say, advertisement income, sponsorship income, 1 rupee, they are required to register and comply with the GST provisions. The liability is only on the one, but then the compliance of registration comes into place. So GST brings a big net of people inside them. Presently the registration is only about 1.7 crores is the number of people registered under GST, and about 30-40% are filing only nil returns. But this is the spirit of, it has increased probably as regards the, the registration provisions are concerned. And if they are saying, if I do business from one state to another state, I have to compulsorily register. There is no limit of that 20 lakhs also. Not for services, but for goods. If I do trading from one state to another state, you should register it. Simple. So it means all e-commerce players will be required to register compulsorily. They will not even have the ability to compliance, but then they are required to register and pay GST for it. Now another question is, sir, my turnover is zero. What is happening is, sorry. Yeah. So the question is, many people register for one more objective also. The moment you register, now what is the assumption people get? I am registered under GST, I have GST number and all. Assumption is, okay, this guy seems to be a very nice guy, compliant person, genuine. Assumption. Okay, that's how it is. Private limited company means perfect. Individual means doubtful. Partnership means lesser doubtful. So this is probably some kind of an assumption which has been created. Probably people in the legal profession will know how different it is. But then that is the assumptions in the corporate world, or not just corporate world, in the general scenario. So somebody is registered under GST but no income is there. Or their income is, let's say, only 5 lakhs. They are registered but income is only 5 lakhs. Should they pay GST for it? Yes. It means that once you register, you have to start paying GST. There is no question of 20 lakhs. So 20 lakhs is only if you choose not to register. Once you register it, even for 1 rupee, you have to start paying GST for the same. See, these are all again points which many people, I would say, are everything will now start getting tested. As I was telling in the first session also, the normal time limit for passing assessment order under GST is getting over only this December 2023 for 17-18, first year of GST implementation. Regular assessment time is getting over by this December 23. Extended time is getting over by 2025 February. Okay, so that is 5 years time from original annual return filing date. Annual return filing date for the first year was about 2020 February. So we are looking at 2025 February for normal time for first year of GST, which means what, 17-25 order is passed. So imagine already it's about 8 years over. And from there you will have all the issues, notices coming up. So that's why I was also telling RBA that this is the right time to know about the GST provisions, because there will be a lot of litigations. There will be already started, and probably tribunal is also not formed. And from 1st of August 23, rules are required to be made to bring the tribunal. And by the time it is formed, it will be end of this 2023. So we are looking at this as a timeline. So probably tribunal formed, you will have last 5 years of appeals, first appeal litigations coming to tribunal, last 5 years of department appeals coming into tribunal, and of course wherever High Court they directly went because tribunal was not formed, with the direction that you pay this pre-deposit, remanded back, wait, stay, etc. will again come back to tribunal. So this is the I would say maybe in a sadistic way, it's an opportunity for the legal professionals to start dealing more on this. And I have not crossed the word registration per se even till now. I'm just talking about this 20 lakhs and 40 lakhs and how much difference it can make with respect to the taxability itself. So let's say somebody is doing 12 lakhs of taxable supply and somebody is doing exempt of 10 lakhs, they are required to register under GST. Simple. So because they have accumulated crossed 20 lakhs. And I'll give you another example. Somebody has earned 19 lakhs, chartered accountant earned 19 lakhs of taxable income, his profession, and even 1.5 lakhs of interest income by keeping his money in the FD, etc. Now, interest on FD, do you think it's taxable under GST? Income tax, different. It has to be taxable or not under GST should be decided. It means it has to be a supply first. The word in GST, the word underlying taxable transaction is supply. If I do supply, it's liable. Supply means what? It includes everything. That's all. It includes sale, barter, exchange, etc. So there's no definition. Like it's not a extensive definition. It's only an inclusive definition. It has given examples of supply. So it includes so many things, which should be in the course or furtherance of business. That's the underlying point. So business has been defined to say that it need not be for profit purpose also. Even if you do one time, it can be business, etc. But it should be trade, commerce, adventure, etc. So this is what summary. Now, a chartered accountant earned interest income during the course of his profession. He had surplus funds, he kept it in the FD and he earned interest out of it. 19 lakhs is professional income, 1,50,000 he earned from FD. Should he register? Or to say whether this FD interest earning is a supply or not. First it has to be a supply, then only we are looking at taxable, exempt and all. Okay. Whether earning interest out of FD is a supply or not. On what grounds, what I told the officers that day, the government officers were also, assume, as I told, between birth and death, it is a supply. As a not supply. Between birth and death, assuming GST, everything is taxable. Try to find out why it is not taxable. Okay. It's always better to say. So you have to say it's not a supply, or you have to say it is not a exempt, it's an exempt supply. Only these two are possible. Okay. So you have to say either it's not a supply or it's an exempt supply. Let's leave about exempt supply. Now you say why it's not a supply. Let's say instead of giving, I give you slightly different. So he had money. Instead of putting FD in the bank, he gave that loan as a loan to his, his another chartered accountant friend because he was in need of money at interest of 2% per month, 3% per month. Whether it is correct under other act and all, let's not get into that. 3% per month he gave interest. Now you tell me with this background whether that is a supply or not.
No, at least second example, at least some activity
Yeah.
he is trying to do. Out of that activity he earns some...
So how far the first one and the second one is different?
No, for first one, by way of investment, he deposits and get an interest.
Yeah.
It's not an activity.
So he thought he will do a better opportunity of earning income by exploring instead of investing in the bank, let me invest in this guy. He gives me 3% per year.
The first one only covers inflation. There is no supply per se. Interest is only in inflation.
No, these are all economic concept. What you are not trying to justify is
Therefore,
that.
there is no supply.
Hmm.
Therefore, there is no supply in the first case, whereas second case there is some sort of activity.
So let's say if instead of 6%, if he earns 8%, so what is inflation? We'll get into so many other questions. Okay, now I'm not a judge to justify. I'm only trying to put the context. So okay, so now the question is, now the second example. Let's take the second example. Is it a supply or not? It is a supply. To put in a different wordings, I gave loan to the bank, and bank gave me 6% interest. I gave loan to somebody, and that company gave me 3% per month interest. If I put it this way, it looks like a supply only. Okay. So now if it is, I'll proceed. Okay. Yeah. So the issue is about in the course or furtherance of business is the word which is used, and the wording used is any trade, commerce, venture in the course or furtherance of business is a supply. Okay. So if with this example he will easily cross. In fact, there's a specific entry giving exemption for interest on loans. That's why banks do not pay GST on interest, because it is exempt by way of a notification. Not because it's exempt by way of notification, it is exempt. Credit card interest has been charged to GST. It's liable for GST also. It is because that, if I have to put in a legal word, somebody is using my money. So there is a use of funds, of my funds by somebody. Okay, so there is an element of activity involved in that way. Chit funds. There are many cases where my funds are used by somebody, and it has been treated as a supply only. And then, if it is not exempt, in my example, interest on FD is exempt by a notification. Interest on loan is exempt per se. So, hence it is not a supply, and hence we do not pay any GST for the same. We do not register, etc.
The exempt supply should also be considered for the purpose of.
Correct. So, but what is you're right. We have to consider exempt also for calculation. And you will find a separate section, another section which says if somebody is exclusively exempt. Okay, in the example of chartered accountant, yes, he has to register. Right. He need not pay GST on that interest portion, but he has to register and pay GST on the chartered accountant services. Yeah. So the 20 lakhs or 40 lakhs calculation itself has been a matter of issue or a debate. And that's where the provision starts. Okay, registration is done. Let's assuming somebody is registered under GST, and his registration gets cancelled for various reasons. There's another opportunity where so much of writs are filed in the court. You will find every day at least 30-40 cases coming up just for cancellation of registration and revocation. Okay, that get cancelled because of various reasons, non-filing of returns or non-payment of taxes. It gets cancelled. So cancelled means they cannot do business. Simple. And basis is that at least you will pay the money, etc. If your registration is cancelled, you will come at that time. At least you will come back to me, and you have to survive your business, etc. So the provision is very clear. It says within 30 days you can apply for revocation of the cancellation of registration, or within 30 days you are not able to come before the proper officer. Then at the ACTC level, at the commissioner level, I'll just close it in a few minutes. So you have a timeline before which you can come. If you miss that bus also, then they are saying you can at least go for appeal. Your first appeal, where you are saying 3 plus 1. With 3 months plus 1 month is that. That is from the date of cancellation of order being served. 3 plus 1 month you can go for, 3 plus 1 is contemptible period, you can go for first appeal. And many cases what happens, it gets cancelled and they do not prefer the appeal or they do not prefer the revocation. Suddenly out of nowhere the dealer comes and says, sir, I need this registration for doing my business. And that's where it goes to the High Court. For under a writ it goes and says, no, this affects his fundamental right to do business, etc. And hence this non-payment means let them go and take other actions, but they should not cancel the registration, etc. And that's what every time it keeps happening. And some cases they do a retrospective cancellation of registration. Like today, but I cancel it from 1st of January 2020. But that has been already challenged quite a few times. How can you cancel it retrospectively? It is being done in many cases. The retrospective cancellation will affect the recipient's input tax credit also. So there are other issues to that. In fact, recipient gets notices saying that your supplier's registration is cancelled retrospectively, so your credit has to be disallowed. Another notice being served. So with all these things, so many writs are getting filed. In fact, there are quite a few judgments where the courts have been considerate to mostly on procedural grounds. Notice not being served or not seen or opportunity not given, or the notice itself is vague. Primarily they say for these reasons, there is no reason at all per se. Contravention of the rules and regulations, hence we are cancelling it. So in this case, there is no clarity on what basis there. So these are all the grounds through which the courts is saying, okay, give one more opportunity for hearing and then pass the order. So that are all basis, but now there is a final opportunity they have given for all these years. Somebody has missed. The government said as recently a few days back, notification has come. Till 31st August 23, you be given an opportunity for revoking your registration. So after all these things, again somebody misses the bus and goes to the judiciary. Probably we don't know how the reactions will be, but then there are matters where they said it's the fault of the dealer, so they will not do it. But I would say 90% of the cases the courts have been considerate, primarily because the ground of registration and cancellation was not clear and adequate. So that's probably the cancellation where so many litigations were happening. And because of cancellation, recipient's credit eligibility and issue on his notices and all also has come up a lot. But overall, to put simply in perspective, registration is deciding basically the entry into GST or exit out of the GST. And somebody registers, does not register, because it affects the liability. The revenue is also now so many tools are there for them.
What are the consequences of non-registration?
Yeah, if you don't register, legally speaking, you don't register.
Is there a penal consequence or any other consequence?
Absolutely. See, if you are not registered, it's a contravention of the rules. Intention means all liabilities you have to pay. That is the tax. Then 100% penalty is there on the tax amount. And that is if it's a section 74, that is fraud, suppression, etc. Normally non-registration will be taken by the department as a suppression case only. Even if we have normal time limit. We have normal time limit till end of this year. But still they may take it as a section 74 case only. So which means 100% of the tax will end up as penalty.
The revenue bar association has to register in the GST. If it exceeds more than 20 lakhs.
Okay. So this is a okay. Actually, this comes under the question of supply itself. So there is a Supreme Court judgment in Calcutta Club few years back, 2019, where they held that that was in the context of service tax, and the wordings of the service tax are pari materia to the wordings of GST, and they said that Supreme Court, a club and all is only an association of persons. It's mutual. Members and club are effectively the same only, and there is no service being provided by them to them in the course or furtherance of business, and hence I'll not finish the story. So hence it's not liable for GST. This came in 2019. After 2017, GST has been introduced. That is because of the word that exemptions have been given for clubs, etc. in specific situations, but there was no specific situation deeming it as a service. Now, in last year, 22, considering the Supreme Court judgment and to reverse that effect, they have retrospectively amended the supply definition from 2017, saying that club association of persons providing services to the members will be deemed as a supply. And in the definition of business, they have told that club associations providing services to the members will be deemed as a business. So there's a specific deeming provision in business, specific deeming provision under supply. Probably that should also be considered. In which case, if the fees, membership fees and all is going to cross 20 lakhs, that has to be evaluated for GST registration. Now that's why resident welfare associations are paying more than 7,500. Madras High Court has some judgments on that also, but not on the taxability, only on the value or liability, etc. So that is the context for a club or an association. So underlying, we have to always see supply. I'll just close with one last line. I refer this judgment, which is an excellent judgment. Most of you may be aware. This is also highlighted in the first session. It was judgment in the case of Tamil Nadu.
In the case of Revenue Bar Association, it only imparts education.
Okay, sir, but that be the case, even for education, we need to be a registered, approved courses for getting exemption. We have got notices there also. Even universities themselves have got notices for courses which are not approved by them, etc. So issues going on there also.
We don't make any supplies. Let's see. We don't make any supplies.
That is the reason. That's the Supreme Court judgment in a simple one nutshell. But now, in the context of the retrospective amendment, we need to again relook at it. But again, you are eligible for input credit also on the other side. If you have expenses, and let's say the RBA happens to be, you have corpus spent, so you are spending out of it, so you have input credit. That you can take. You also have to look at whether there's a possibility of, taking credit and paying, and hence you may end up having some surplus. Right now, the judgment was in the context of Government of Tamil Nadu versus Madras Port Trust, 1939 judgment. Sorry, 1939 TNGST law. And then the judgment was 1954. And again the same issue came up and finally was decided by the Supreme Court in 1999. So, as you know, 1939 the TNGST law came. And from there this issue started. In 1999 in the TNGST 1959 law it was settled. And after that law was amended in TN VAT Act to block all the loopholes. The simple judgment, which is most important for all the definition, it was on the sale. But it's still relevant even for GST also, is this underlying point. Let's say somebody says you have to pay GST. The first provision in that section, the Madras High Court, the Madras High Court then finally went to Supreme Court was, what is your objective? Is what they tried. That judgment was on sale of abandoned goods in the port. Like port, you have so many people, importers and all, they just leave the goods if they don't like it or they don't want it or for various reasons, it's abandoned. Port Trust was selling these abandoned goods in the auction. Sales tax department is saying you need to pay sales tax for this because you are making a sale only, so transfer of ownership, etc. So Madras Port Trust we cannot pay. Why? We are not a dealer. What is a dealer? Somebody who is doing this in the course or furtherance of business. This is not our business. Hence we will not pay GST for this. Our business is not to do sale of these things. Our business is not even business. Our objective is only to manage the Port Trust. Hence decided, High Court, Supreme Court decided, yes, Port Trust is correct. Then the law was amended to say, dealer, anything incidental or ancillary to business is also business. Again, Port Trust did not pay. Okay. Again, single member bench, High Court said, Port Trust has to pay. It's incidental ancillary only, so you should pay. Then went to the division bench, they said, Port Trust is correct, not liable. Supreme Court went, they also said Port Trust is correct. That's 1999 judgment. They said, incidental or ancillary to what? To a business only can be a business. If my primary objective is not a business, anything incidental or ancillary, even if separately it may be a business activity, does not amount to a business because it's not the case of the department. That was a specific observation. It's not the case of the department that the activity per se constitute business. The case of the department was it is incidental or ancillary to business. This is not incidental or ancillary to the business. There is no business per se to be incidental or ancillary. Hence, they said it's not liable. Then again it was amended in the TN VAT law and they concluded it. Okay. So the law was sufficiently amended to bring all these things. You will not believe the same issue again started in GST also because those amendments have been taken away in GST. So we are back to 1939 law as regards supply definition is concerned. So with this I will close the issue. Thank you so much.
Our president is more time conscious. He is not allowing me to sit there. I thank Mr. Srinivasan. Is this topic concluded or we are going to continue in the next
Registration complete.
It's complete. So next meeting we are going to go on time. Which topic next month? Time of soccer. Time of soccer. Right. I thank Mr. Srinivasan. It has been a very good interactive session. I think physical session is much better than going online. What do you prefer, sir? This is better. Okay. Thank you. Thanks, sir. Now Mr. Anand will take over.
So the clarity of the session was so much that the intensity of the GST was felt by our president. Although the speaker did not take a cup of water, the president had a cup of water. To tell in Tamil, thank you, sir. Our association is a hub of immense talents and resource to provide exceptional speakers for our study circle meeting. Our members are passionate about sharing the knowledge and insights. Revenue Bar believes in nurturing young talents and also own talents by providing opportunities to our members to share their knowledge, thought, insight and experiences. The future of our association lies in the hands of these talented and promising speakers from our association. We feel a shared sense of pride when we see our colleagues stepping onto the stage, speaking with passion and conviction. The topic for today's study circle is overview of DTAA post-multilateral instrument. It is not only the speaker who requires introduction, even the topic requires an introduction. Tax treaties are bilateral agreements between two countries aimed at preventing double taxation and determining which country has the right to tax certain types of income. However, the process of amending bilateral tax treaties can be time-consuming and reaching a consensus among numerous countries can be challenged. The multilateral instruments work as a super treaty that modifies existing bilateral tax treaties between participating countries without requiring separate negotiations for each agreement. The source person for today's study circle meeting is none other than our own association member, Srimati Sri Lakshmi Valli. The topic is overview of DTAA post-MTI. A highly accomplished professional with an impressive array of qualification and expertise in the field of banking management, chartered accountancy, cost accountancy, and advocacy. With a robust educational background, Srimati Sri Lakshmi Valli holds a graduate degree in banking management and is a qualified chartered accountant and cost accountant. Her pursuit of knowledge extends globally as she earned an advanced diploma in international taxation from the prestigious Chartered Institute of Taxation in the United Kingdom, as well as diploma in international taxation from Institute of Chartered Accountants of India. Currently, Sri Lakshmi Valli serves as a practicing advocate at Mrs. V. Ramchandran Advocates. Her contribution to the field of taxation extends beyond her professional responsibilities. She has actively participated in the publication of a book on transfer pricing. In 2014 and 17, she served as a co-opted member of Committee of International Taxation at the Southern Indian Regional Council of ICAI. Furthermore, in the council year 2020-2023, she was a member of the group constituted by the Committee on International Taxation of ICAI. Our research person has an impressive track record of academic achievement, professional experience, and contribution in the field of international tax. Over to you, ma'am. I also take this opportunity to all the participants who have participated through their were already logged in.
Good evening, everybody. First, I would like to thank my senior, Bhaskar sir. He has to actually leave for Bangalore, and I requested and he had come over. Actually, he thought mine will be the first session. He told I'll just stay and then leave. and mine happens to be the second. He has stayed the full 1 hour and then he is sitting here. So thank you very much, sir. Seek your blessings before I start. And next to Sridhar, sir, for giving me this opportunity and the way he has been following up and giving me confidence. So thank you very much, sir. Thanks to RBA for giving this opportunity. Thanks to Aman, sir. He has added other things and all what I did not there in that resume. Thank you. First, the topic for today which I've chosen is, again, thanks for giving me this opportunity to talk on a subject which I am passionate about. International taxation is my passion. So what has been chosen is overview of DTA's post MLI. What I intend to cover, why BEPS and why MLI. That will be the major part. The overview would be just an overview because this is what we need to understand about MLI. Before that, why MLI? What had happened? The history, I think generally when we know about the history earlier, what has happened, we'll be able to appreciate the present and the future. So for that reason, I will give more time on the first two parts. In the conference on 7, they kept a quiz on GST, indirect taxes. Direct tax was missed out. Me and Muthu, we were just shouting from the back for whatever small questions that we knew and thought that the next opportunity comes, there should be a quiz on direct taxes also. But here now it's international taxation, so I've chosen international taxation. This would be the base, based on which then we can build upon the BEPS and the MLI. So I would start, and for this I would need the help of my colleagues Dineshji and Kadiji for their gifts. So to identify and then to give the gift, so I give it to him. We'll start? We'll start?
Yes, yes. OECD.
But still for the benefit of all, developed countries generally follow this method of taxation. OECD is right. In UN model income is taxed based on
Residence and source.
Can the same person ask again?
Residence and source.
Residence and source. The third question. This actually Vikrams are covered on 1st of July. India US DTA took dash years to conclude and sign off. Several years. 30, but she has already got it. I think, okay, fine. I think she will accumulate. The longest I feel like. And that's why we find all that make available clauses and all the extent possible. We try to use that. Make it available, but at what cost? BEP stands for?
Second note.
Who ji Dinesh? You have to see who?
Here.
Yes, India has signed about dash DTAs with other countries. Yes. It's actually 93 or 94. MLI 93. Double taxation relief could be?
Both.
Everyone. Yes. And SSC is eligible to claim benefit under?
Whichever is beneficial.
Yeah, sir. All are there, but oh my goodness. Whichever is beneficial, Income Tax Act or the Double Taxation Agreement, whichever is beneficial. This one, diverted profit tax is also known as
Google tax.
So it's actually little easier. Since diverted profit, someone may not have heard, so I put it easier. Otherwise, I could have put little tough also. Amazon tax, Apple tax. 10 people. Who told? They have to volunteer now. Who told? Other than no one else, then finally she will get it. Muthu should get. I'm happy that someone is answering. This one, on imposition of digital service tax, US initiated investigation under 301, no action, appreciated India. What did they do? US. Anyone can guess.
No action.
So, no pen. It's actually Section 301, knowing US, if they would initiate action. As of now, they have stopped it.
Section 301 no?
USTR, their regulations, Trade Regulations Act. This is like stick. If you tax our companies, then we know what to do. That is this. Section 301. The last one. DTAs, little tricky. DTAs gave rise to opportunities for double non-taxation or double taxation?
Double taxation. Double taxation.
Sir, here.
Concept basics. See that?
Yeah. Thank you very much. I'm so happy. Now we start with the topic per se. Why webs? Now, why these things are happening? Earlier, whenever there is a trade, then what happens? One country will come and invest in another country and try to make profits out of that country. Those days and all, it was all developed countries which were investing in another country, making huge profits. And suppose say UK, it had colonies everywhere. So they were able to, when their residents were going across the globe, earning money, paying based on residence. So to UK. UK was very happy. You go anywhere, you earn taxes, earn income anywhere, but you are going to pay me the taxes. I am happy. But what happened to the other countries, where they went and where they did all the business and all? Nothing. So at that, this was actually the rich man club. OECD is the rich man club. So based on that, they were going about. Then what happened to the poor men? United Nations, they came forward. Okay, we will form a model that is based what sir told, like the source. Okay, you tax it there, but pay some here also, some money here also. That is where we come up with the withholding taxes on royalty and FTS, for which we fight about like whether it is taxable or not taxable. But what is the base? Everything goes to the residence tax, but nothing gets paid here in the source. So they also should be paid. For that reason only the source-based taxation came up. They were all very happy till this time. They were getting the money. Okay, certain amount was, certain percentage, 10% or something was being paid. Even there will be many beneficial provisions in the DTAA. Only when you are the beneficial owner, you will get a reduced rate, otherwise a high rate. So those things are subject to that. Still it was going on. Residence plus the source-based taxation was going on. But Karma, this is actually the Karma. One day they found, the Richmond's Club, they found these MNCs were actually earlier making money everywhere and then coming back and paying us. Now the MNCs became intelligent. Why to pay them also? When we can evade taxes here in the source country, let me evade tax in my residence country also. It was at that point of time they woke up. Oh no, this cannot happen. Then what? Go to OECD. Now find a method, because we feel that our profits are now moving down. At this point of time, we have to say something. For this reason, I have got a video. Can you give a minute? I'll just try to play the video as well. All of the pages open but for this.
First, it was the bankers who were hauled before Parliament to explain their financial operations. Now MPs who spread the net to take in a range of other companies. Starbucks, Amazon and Google executives have all been appearing in front of the Public Accounts Committee this afternoon to face charges that they were using legal but undesirable methods to minimize tax payments in this country. Our business correspondent Siobhan Kennedy followed the exchanges.
Three top names in the British economy, but how much tax do they pay? Google, £6 million, Amazon, £1.8 million, Starbucks, nothing at all. It was outrage over those numbers that led to heated exchanges with MPs today, as three bosses from the firms were lined up for a grilling. The MPs say sales in Britain, yet through financial trickery appear to make very little taxable profit.
I don't find your business model very compelling or convincing. It seems to me that this is a system specifically designed to avoid tax.
Respectfully, I can assure you there's no tax avoidance here. We have a global tax rate of 33% around the world. We clearly are not aggressively looking to avoid tax. We're looking to avoid tax on any structure anywhere.
But isn't that just a load of hot air? Sales are big here, but Starbucks has somehow managed to make a loss in 14 of the last 15 years. The suspicion that the company deliberately moves profits out of the UK to avoid paying taxes here.
You've run the business for 15 years and you're losing, and you're carrying on investing here. It just doesn't ring true.
We are committed to this marketplace, to our customers. We know to be a
You're losing money.
successful global company, we have every intention to make this market successful and profitable.
It just doesn't ring true, Mr. Oxford. That's what frustrates taxpayers in the UK.
Companies like Starbucks claim they're not technically breaking any rules. But in an age of austerity, when ordinary people are being asked to stomach huge cuts, there's a growing sense of anger that big business...
Evidence, say campaigners, that Britain is the real centre of Amazon's operations. Although the Amazon executive appeared fuzzy on the numbers today.
And I possibly pretend, and it's really quite annoying to listen to, that you possibly remain in strategy in Europe and not know your territorial profitability. You're doing advertising, you're putting warehouses on the assumption of sales volume. Don't come on, it's actually quite insulting to everybody's intelligence to say you don't know what sales volumes are going to be in the territory. That's just not feasible as an argument.
It's not numbers that we do disclose, but I'm very happy to go back to the company and see whether we're willing to.
And it was the same argument with Google, though the UK boss was a little more robust in his defence.
So you're minimising your tax even though it's unfair to British taxpayers?
It's not unfair to British taxpayers. We pay all the tax you require us to pay in the UK. We paid £6 million in tax last year.
We're not accusing you of being illegal, we're accusing you of being immoral.
I think it's not a matter of personal choice.
It may not be, but the argument over the tax choice of business in Britain is certainly not over yet.
So UK felt the heat that the big companies are not paying their paying taxes, even though the activity was happening there. The same thing only the source countries were earlier saying that, but now they got it. At that point of time, Ms. Margaret Hodge, actually what she said was, I know that you are not doing something illegal, but it is immoral. But can morality come into play for taxation? That is another question to be answered, but still.
Answer is simple, no.
Yes, but still, they went ahead and then now they are saying that no, you have to now pay taxes. How? For that they got OECD. And what did OECD say? What is BEPS? Base erosion and profit shifting. This is the definition from the OECD. Actually, that video was 2012 video. When I saw that it actually goes for 2 hours or so, felt vindicated. Felt so happy at that point of time that yes, karma does work. Base erosion and profit shifting BEPS. Tax planning strategies that exploit gaps and mismatches in tax rules to make profits disappear for tax purposes or to shift profits to locations where there is little or no real activity, but the taxes are low, resulting in little or no overall corporate taxes being paid. So basically they say that profits get shifted. Shifted where? To jurisdictions where there are low taxes. And at the end, what happens? They take the benefit, that is basically the treaty shopping. They go to the place where the treaty shopping gives them a benefit, like earlier India, Mauritius, capital gains tax, the famous one. it is not taxable. It is not taxable there. It is taxable only in Mauritius. And Mauritius, they say that domestic law is not taxable at all. Final. So, not taxable in India, not taxable in Mauritius. The whole Vodafone issue was based on that only. The whole elephant was covered under a small hanky, and still they went ahead with that. So, here it is basically resulting in double non-taxation. So, DTAs, what DTAs basically do? DTAs cannot actually tax additionally. What can be taxed is only as per the Indian Income Tax Act. Our section 5 and 9. With that we have to stop. We cannot go beyond further. But what double taxation agreements do is, the two countries come together, okay, we will give you certain benefit, because suppose as a resident, I tax you say at 30%, India taxes the person who goes to Singapore and does some business, I tax you fully at 30%. In Singapore, say it is 18 to 20%, you pay this 18 to 20% there in Singapore also for the same profit earned. Then what happens, say they make a profit of say 30 rupees out of 100 investment, half of it, 30 plus 20, they have to shell out. That they felt, yes, it is not correct. You have to be given benefit. Who will give the benefit? Who will give the benefit? Two countries, a person pays the taxes from India, he goes over to Singapore, does business there, pays taxes there, comes back here. As a resident, he has to pay here. There he did business, here I am a resident. Said paid 20% there, he paid 30% here. Now, India and Singapore get into an agreement. Double taxation, avoidance agreement. So it can only avoid, it cannot increase. Like the tribunal, I believe. Only benefit can be given, you cannot increase the cost further. So what benefit now? 30 here, 20 there. Generally there are two methods. Exemption method, the resident country, if it feels that it is very magnanimous, it will say that the whole 20% you need not pay. So out of the 30 rupees taxation, when you compute the taxes, 30 rupees out of 100, 20 you have already paid, minus 20, 10 rupees alone you pay, I will accept. So India foregoes that 20, that is the big amount for a country to forego. So that's why resident countries are very careful in drafting. So I remember on 7th July also when IAS madam was talking, earlier and all the agreements, the PIPs and all were signed easily. Later on only they realized the developed countries, they think over it, plan and then do it. We actually, afterwards the action has happened, then we think over it and now only we are correcting it. Again now BEPS and MLI, they are one step ahead. They are only deciding, US is not part of it. They are watching it from outside. I will cover that also. So here now, 30 rupees, exempt method. 20 rupees, whatever you pay to Singapore, you need not have to pay here. 10 rupees balance, you pay here, I'm happy with it. Another one is like the credit method. I will not fully exempt. To the extent of the profits only they will exempt. So generally India will not fully exempt it. Generally many of the countries go for the exemption credit method only. Whatever taxes you have paid there, to that extent you claim the credit, not the tax liability. What you have paid as taxes, get the credit here. So to that extent the methods are there. So this is the double taxation avoidance agreement which was working out. But this allowed benefits, say a country enters into a as I said about the Mauritius. So what was happening? An income was not getting taxed neither in India nor in Mauritius. It was going non-taxed. So at that point of time only it was felt that since there is a base erosion, we have to work over it. And OECD in 2012, actually UN and OECD were very lull at that point of time. So when this project was taken up, there was a lot of thoughts like whether this will really kickstart, whether it will happen. But OECD went very fast. In 3 years' time, they developed this action plan, 15 action plans. But the first one, what happens? Addressing the tax challenges of digital economy. Digital economy, US, all the companies are based at US. Whether US will allow it to happen. This was in 2012 they identified. Was 2012 the year which really was felt that there are digital taxation problems? In 1999, I believe in Ottawa or so. There, that time itself it was being looked at whether electronic commerce, because 2000 and all was the electronic age. It started. So at that point of time itself it was realized that there will be difficulty in electronic taxation. So we have to come up with rules. But US saw to it that it will never fructify. So from that time onwards, from 2000 to, even if you start with 2000 till 2012, nothing happened. In 2015 they came up. Did anything happen? Till now, whether BEPS 1.0, this was the first action plan. Nothing happened, 1.0 is there. In BREX 2.0, then they told, okay, let us do something in 2.0, and 2.0 is also still ... Nothing has happened. So US is taking care of its residents very well. Other things and all, yes, there are many other points that have got covered, and which is good also, like Action 2. Neutralizing the, and I think at this point of time I will mention about the digital economy. We had the equalization levy. Equalization levy came up, significant economic presence, that also came up. Significant economic presence is, if at all any digital company is able to, actually we say digital company was aimed at, digital company comes over and does business over here online, then yes, it is going to be taxable. But the double taxation avoidance agreements have not been changed. Only the Indian income tax has got amended. So we saw one question, which one will overrule? Indian Income Tax Act or the double taxation avoidance agreement, whichever is beneficial. So since DTA is not amended, so whatever comes in section 9 will be overruled by the provisions of the articles in the double taxation avoidance agreement, which was detailed covered by Vikram sir. That's why I will not repeat it here. In that, the business profits and all will get covered over there. So in that it says that only if you have a P, the ground always be taken. No P, no business income charge. SK, gone through. So that still is there. That option is still available. So because of that, the significant economic presence can only work for countries with which we have not signed a DTAA. Earlier it was Hong Kong. Hong Kong we signed off. So there are only maybe few countries with which DTAA is not signed off, which may be of importance to us. So all of them are getting the benefit. Section 9 will not have an impact. But the same way, if you think of FATCA, it is that foreign tax credit account, I think. So whatever, when we go and open an account in the bank also, we have to sign one FATCA form. That, what was this form actually is, that you're not a resident of US. That has to be signed off from, everyone has to sign off. This was brought by US because it wanted to check. Is my resident not paying taxes anywhere in the world? Anywhere in the world. So all the countries, all the banking systems, all the financial institutions were asked to get a letter from their customers saying that, are you a resident of US or not? This involved, at that point of time, I was with Stanchart Group. I remember there was a core committee being set up to amend all the, what are the difficulties involved. If at all this procedure has to go to a bank, they have to get it from each and every customer. How much of procedures they have to look at. They made it a point that all the countries, all the banks, all the financial institutions did this so that they can track each and every US resident and whether the taxes are being paid. And this, when it happened, 2010, it was signed in America. 2015, the intergovernmental agreement between India and 5 years was sufficient. Now for digital economy, 23 years, still it is not able to find its way. US is taking care. The second one, Action 2, neutralizing the impact of hybrid mismatch agreements. I will just touch upon 2-3 points so that we understand the depth with which the double taxation avoidance agreements have been going about. Suppose there is a convertible debenture. So a debenture is being issued now. After 1 or 2 years, it will get converted into a preference equity share. So now it is a loan. Tomorrow it will become equity. So in one country, they may say, if it is a debenture, this year for me, till the time it becomes equity, I will consider it as a debenture, loan only. Another country will have a viewpoint. Anyway, it is going to get converted into equity. I will look into from that perspective. So what happens now? One country will treat it as a equity for which dividend will come, which may be exempt in that country, income not taxed. Another country will say, no, for me this is a loan. When I am paying it, it is an interest deductible. It's not even just non-taxation, double it. Income is not taxed, expenditure is also claimed. So to arrest that, this was neutralizing. So when one of my seniors has told me, like, if at all you don't understand, read from the back. It is an arrangement where there is a mismatch, hybrid mismatch, equity or a debenture. And what is that impact? For that impact, you have to now neutralize it. So this is the way they have tried for Action 2. Now, action 3. Designing effective control foreign companies. CFC rules. CFC rules were brought about in our income tax also. They were looking at DTC. It came up but did not see the light of it. What is it? Again, read from the back. It is a company which is a foreign company but which is controlled, say, from our country. Say it is an Indian company, Tata, it is having lot of countries outside of India. Control is from India only. Like the poem rule. Effective management is happening from India. So who should tax it? Everything is happening here for the namesake, the companies outside, even though they may be incorporated outside India, the subsidiary. If that is generally what we'll see, where it is incorporated, it is subsidiary, then we need not have to. Only if it is a branch, then we consider. No, the control is happening from here. These are all the methods. So this, they told, here also we have to design rules so that foreign companies controlled from India, they should also get taxed over here. Action 4. Limiting base erosion involving interest deductions and other financial payments. This actually came into our own income tax itself. If at all your debt equity ratio, when we used to study, it used to be like say 2:1. Equity 1, debt 2. To the extent of like the investments are huge, then 5:1, etc. But they may be made too huge that equity share capital will be only 1 lakh. All the debt will be in crores. And what you do, you say that I got it from my head office or my parent company. Now I have to pay interest. All the profits will grow like that. Here the losses will be booked. So these are all various methods India has brought in. So to that extent, this gets arrested. Action 5. Countering harmful tax practices more effectively, taking into account transparency in substance. Cayman Islands, Bahamas, etc. So most of the transactions happening over there, we will not even know what is happening. How will India come to know? Exchange of information. The tax exchange of information, that has become robust. Many of the countries now, they were like blacklisted, otherwise they were told that you will be blacklisted. So for the fear of blacklisting, so they have now started giving information, exchanges happening. Action 6. Preventing the granting of treaty benefits in appropriate circumstances. This also is now being addressed. Like, if you see the Mauritius agreement, I believe, like, for economic cooperation only it was entered in. I think even when the Azadi Bachao Andolan was argued, I was told that the reason being not just the economic reason but political reason also were involved in that. So economic and political reasons too play a great part while drafting of the double taxation avoidance agreements. But now it has to be arrested, saying that it should not result in non-taxation. So that should also be one of the point to be taken care. So that is being addressed in action 6. Action 7 is preventing the artificial avoidance of permanent establishment status. The first thing when we see that suppose no PE, if at all PE also, then what we will try to look at is whether we can get out of the exceptions. It is only a warehouse. Okay, then I need not have to look at the PE part of it. So looking at the exceptions part of it, so what are all they, how to address. If at all there is going to be a construction contract, split it up. I will do a part, another subsidiary company will take another part. We will spend, see the number of days, which is the cutoff, 90 days. I will stay less than 90 days, he will stay less than 90 days. That fragmentation was happening. So those things need to be taken care. So that is being addressed. Action 8 to 10. Transfer pricing outcomes with the value creation. Basically, it's on intangibles, it's on risk, capital. Then the 10th one was with respect to high value items. And while here with respect to transfer pricing rules, I think ours are robust to that extent. So this I would say is being looked at. 11th one is measuring and monitoring BEPS. Whatever is the humongous data being produced. So that also needs to be monitored. So for that itself they have one article. Action 12, mandatory disclosure rules. This is actually, if at all a company is going to enter into an arrangement, they will actually keep it very secret. If at all it is going to be really aggressive. I remember seeing it, aggressive, medium, low. That rating they will give whenever a tax department enters into a country tax team will give that rating. So that based on that they will take it up with their top team management to keep them informed that yes, there is an aggressive planning happening to this extent. For this, we are taking a risk and the management will be aware. Now they say that that has to be disclosed. This rule I think was already there in UK also, like, and they were disclosing, but now this is like, you have to disclose, this will be apart from the tax. In one way, it is actually a risk. If you see, you are just keeping your books bare, everything bare, so to what extent that is safe? To that extent, the governments have to take care that the data security is being taken care. Otherwise, I'm fully open before you. So to that extent, the risks are there. To that extent, so the government also should take care that they are taking care of the security part of it. Security of the data is very essential. Action 13, guidance on transfer pricing documentation and country by country reporting, the CBCR reporting. This also is already there. Where actually whatever is there in the transfer pricing report, that is one level local data. Then the master file data is also there, where they actually say the substance can be found out. Say if you say that in Mauritius, I have a company where there are 10 people, the asset, because my intangibles are all sitting over there, assets is valued at 100 crores. 10 people and 100 crores, straight away it will show the risk. I think the systems in the tax departments, they will always have that throughout. So this will get thrown out. So this will get attracted. So these data are now being asked from the companies, though there's the higher thresholds being given, I think 750 million, etc. and pounds and all. So, but still, the bigger companies who have the opportunity to do such things, only the MNCs. MNCs only will play around. The Indian company, domestic taxation, came in 2012. In 2005, went away because they found out, okay, at the end of the day, 40 LP, how much money is going to go out? Nothing. If not A, then B is going to get taxed. That is fine. But here it is, they go out. So to that extent, CBCR report is very exhaustive and gets covered. So that is a good thing. And through exchange of information, it will move to places. Action 14 is making dispute resolution mechanisms more effective. We have MAP, mutual agreement procedure. If at all there is a resident says that I have a problem with the assessments, within 3 years they have to approach the competent authority, the income tax authority, relevant authority, and here once they give it, it is the competent authority which will decide if it is unilateral within the country. Bilateral means the other country's competent authority, both of them only will sit together, nowhere the taxpayer will be involved, and they will resolve. But this was actually earlier taking time. Now, due to the pressure, there are peer reviews being conducted by OECD teams, etc. They form teams and then come over and do audit. So because of that, the number of days are coming now. I think 3 years plus is for India. So we are trying to reduce, and the number of cases which are pending, that also is being shared by the income tax department, saying that okay, we have this much before, this much after this date, and this much is the number of years we are taking. So there is a tag along, and then that is being checked. The other part of it is arbitration, which MLI is looking for. That I will cover a little later. Action 15 is the MLI. Now only we come to the part of the topic that we have taken about is the MLI is the 15th action plan. This is a multilateral instrument. Why MLI? All these changes have to be incorporated in the double taxation avoidance agreement, but that will take a humongous time. India has entered into for about 93 countries, and we saw that for India, US, it took 30 years. Even if you take a few years, how long it will take for 93 countries, because the same department cannot work in with all the countries at the same point of time and get it corrected. So then it will take time. So they realized then there are about more than 3,000 tax treaties across 130 jurisdictions. So let us arrive at one instrument which will cover everything. This was a very unique one, unique one for taxation at that point of time. It seems for other trade and all they had it. So they were looking at methods used for taxation. They had a lot of discussion for this. The legal paper is also available in the website. How it has to be looked at and all. And finally, this has been signed in 2017. MLI got signed off. So why MLI? As DTAA, this is the one step next to MLI. MLI is one step ahead. So as DTAA cannot increase the taxes, MLI too also cannot touch on increasing the taxes. It can only help you to address the issues. Whatever issues are there, you can resolve. Then it is a mutual understanding. So what happens? You cannot say that this country has to accept. The other country has to accept the same point. Very difficult. Two people in the house, it's very difficult to adjust. So the countries across have to adjust. And for this reason, they brought all points of thinking, okay, you can take this. They drafted one big instrument. They told, okay, if for one article, you can choose A, you can choose B, you can choose not applicable, you can choose A plus B. All options were given that. Now, understanding MLA itself is like a difficult task. Because earlier we used to have DTAA, taxation and DTAA at least, okay, these two things now we have to. Now, third thing also now comes up. Now, we have to look into the MLA also, which has so many options, and both the countries have to accept the same notification or the same article, only then it will apply. So for each and everything you have to go and check. Humongous work. So, but to that extent they have been working on it and they have created a database which also I will just show that how they are trying to address. Till now I covered action plans as per DTAA. The 15 was action plans. Now, this is MLI articles. Again, the confusion. If we say article, whether DTAA article or an MLI article. So, to that extent, one has to be alert. So, to that extent, even I will not go through in detail on each and everything because it will be too much of a detail. And in that case, I would request that President can give another session, which will be other than the overview, can go a little in depth into it. And for that, I have to study a little more also. Now, this is what I have studied now will not help. It's too much. So, this article, what they say now, generally the scope and the article to the definitions part of it will get covered. So, here they say that agreement, this agreement is called as a CTA, no, different name, covered tax agreement. That was the DTAA. So, I think we have to do that in the smaller age and all. We used to have similarities and differences. We have to now put a column, line in between and then say this is the difference, this is what, this how this is called here, how a country is called here. There we in DTAA we have jurisdiction, contracting jurisdiction. Here it will be not jurisdiction, here it will be party. Why a party? Because there they say a state plus one more jurisdiction or enterprise, because there are certain countries of United Kingdom like Isle of Man, I think, or something like that. So those are all not states, but United Kingdom says we will take a responsibility for that. So they become jurisdiction, then party plus that state plus that jurisdiction becomes a party now. So the contracting party, but then here a jurisdiction. So all this we have to now be aware of when we read the MLI. So scope of MLI, when it will enter into force, when it will come, so that part of it. Hybrid mismatches is what that equity the ventures part. Transparent entities. Transparent entities are, we don't have like that because for us it is the partnership. Easier to understand. Two people join together, they are a partnership, then the taxes are given separately. Okay, this is the tax rate that you have to pay. Easier then. But in certain countries, that is the pass-through entity, they say. It's transparent entity, so the partnership firm will not be taxed, the partners will be taxed. So at the time of TDS deduction, we have to see whether it is a transparent entity there in that country or not. That we would have been doing it earlier also, but then here we have to be even more cautious because it may happen that the partner need not be a resident of that country. Then it complicates further. So how it has to be looked at. So those things and all will get addressed. The transparent entity, dual resident entity. As of now, only the companies are getting covered over here. For individuals, we have that habitual abode where there are economic interest. Based on that, there are 4 rules. We have to follow that rule where we fall. Based on that, they will decide. Suppose, because nowadays this has become very, especially in the COVID period and all, like a person will stay in one country, work for another country. At least there you are stay put. But nowadays, people are nomads, and they are not resident of any of the country. If you're less than 60 days in all the countries, you can plan it that way. Not a resident of any of the country, escape. For that only Section 6 was amended. Not anywhere, then at least then come over here if you have the roots here. So to that extent, that is why I think the taxation is also getting tougher day by day. But the dual resident entities here for the companies, they have addressed. In ours, it is basically the poem. And they say that if at all it's not going, then go for a competent authority. Let the two taxation authorities decide. That's all. But it's saying is easier, the procedures, that and all, and the cost. That will add to it. So that needs to be taken care at what cost. Treaty abuse, methods of elimination of double tax, that is whether exemption method or the credit method and all. So that treaty abuse, how, so what all we saw earlier, now how to prevent it. Like you, in the double tax, this is a, you have to take it. It is the main one. In MLI, the preamble has to be added in all the DTAAs. This is the compulsory one. This preamble alone, saying what? That double non-taxation has to be taken care of. So that word should be there now. So that has to be added by all the countries who all want to come into MLI. This is compulsory. US is not into it. US says that we have taken care, and you are targeting us only for all the US digital companies only are being targeted. That's why they initiated the 301 action, saying that whatever expos you're doing from there, then you have to pay additional taxes. To that extent, it came up. Then there was a discussion, and then they told that it BEPS by 31st of December 23. That gets resolved. That EL will be taken off. The digital taxes will be taken off, and BEPS 2 will come into play. Then to that extent, this 301 is put on hold. So 301 initiated, and then it was initiated against France also. France, UK, I think Austria, few of the European countries, and also everywhere there is a non-state. So that is the thread they use. Prevention of treaty abuse, dividend transaction transfer and all, I believe, capital gains. Dividend transfer, to that extent, maybe 365 days of holding should be there. Only then you can take the benefit. That is what they want. At least for 1 year you hold it and then take the benefit now. Fine. Capital gains, the value derived at least 50%. Then it has to be taxed from where the value comes. That is the section 9 part of it. So that needs to be addressed. Sorry, am I going a little fast? I have another 10 minutes. I think I will cover it. Anti-abuse, avoidance of P status. This is the commissioner arrangements is basically like a person here in India will be an agent of the foreign company. He will do everything till he gets the contract, everything till the sign-off. Sign-off alone will happen outside. So he says he is not my agent, or maybe an independent agent. So everything gets done outside, so taxed outside, nothing here in India. Because if it all done in India, signed off in India, then again the Indian taxation will come. So this is there for others also. So the commissioner arrangements are now being looked into. That exemptions, what is section 5, article 5P, what are all the exemptions, if at all, and auxiliary activity. Then in that case also, if it is not a main activity, then that means they are not doing the business over here. If a company comes over here and sets up an activity, just an auxiliary activity of warehousing, need not have to tax them, leave it. Now they are going to look into those things. Splitting up of contracts, the fragmentation of contracts will be looked in. Closely related enterprise, they say more than 50% of the shareholding means then we are close, then we have to look into the transaction as together only. Improving dispute resolution, now they are bringing in arbitration. There are arbitration is happening in India, but here what they are looking at is it has to be made compulsory. India has not gone for this. They have told that it is the priority of the government, which you cannot touch. Arbitration means what? Actually, I went through they actually release guidance notes, sort, and then ask for opinions. And anyone can respond to it, and all the response will be put over in the OECD website, and from there they will take the feedback and then develop over it. In that, actually they have many of the concerns were there that even within their team they were not happy with the arbitration, how it is going to be done, because even for MAP they were saying they will be taking people outside of the government agency. An expert will be taken. Why? From that thought comes that why not, whether the income tax department is not competent enough to have their own experts, why a third party experts, and they themselves, some of them have expressed that how independent will the experts be? And we know the plans of Richmond, how they will work, and all these would be planned. So who will get into the arbitration, because you have to take in from a pool of experts. Who will be that pool? So all this works, so India has told no, we are not going in for arbitration. MAP is mutual agreement procedure we covered. Corresponding adjustment. Corresponding adjustment is already there in our double taxation avoidance. This is actually a one step. Primary adjustment in the transfer pricing is what, suppose there is an transfer pricing adjustment being made by an Indian entity. Instead of 100 as the income, 120 is taxed as the income. So 20 rupees extra is taxed over here. So what happened to 20? 20 is taxed here as income, and there was a corresponding adjustment. To that extent, I think the tax laws were amended that 20 rupees should be brought into India also. That amendment has also come into India. That not just taxing, bring that money also, otherwise it will be treated as a loan or some interest needs to be paid and all that point came. They say that this 20 rupees here is an income, then 20 rupees should be allowed as an expenditure in the other country. So that is corresponding adjustment. That looks okay, feasible, fine, whatever is good then fine. And final provisions are what the dates and all, when it will just kickstart, etc. Now only I will say impact of the topic in MLI on DTW. Why this flowchart is, there are lots of flowcharts being drawn. So going and looking into it and then understanding this has become a like a joke. This is the reference material. Main is the MLI articles that we saw. So what all we need to refer? There is an explanatory statement, a detailed explanatory statement being issued. There are notifications of the cover taxation agreements like this is what is my stand. Each country says. BIPS matching database is there, that I will show. Then synthesized text. So what they have done is, in the DTAA itself earlier and all, we used to just open the DTAA and then read it. Now what they have done, two countries may sit together and say that, okay, I am saying this change, you are saying this change. Let us put it in the DTAA, override it. They add it as a box. So it's easier to read, but they say that this is called a synthesized DTAA, and this may not be taken as a legal document. But why? Two tax authorities are sitting over it, and they themselves are giving a disclaimer that this should not be taken also. But this again could be a point of discussion as to why they say so, but still it could be considered when OECD guidance notes, the commentaries and all are being relied upon by the courts. Why not synthesize the text which is being agreed upon by the tax authorities themselves, and then various notes, etc. Considering the time, I will just leave. So these are the, like, what date. So for India, this entry into force, 1st July 2018 is entry into force of MLI as such. Because they told that 5 countries have to accept, only then MLI will come into place. Those signed in 2017, 2018 was entry into force. USA and Brazil are out of it. Brazil, they say that their tax laws are very difficult, so they thought that better they will amend the DTAAs which are lesser as compared to amending an MLA. Don't know to what extent it's right. Mauritius and Germany. Now, both even if MLA comes into play, we have agreed that okay, we will want to amend your DTAA. Other country also has to say, they are told, we don't want you. Mauritius and Germany. These are all the steps which I will skip. This one. There is a press release by the Income Tax Department. It's the 2nd of July 2019. They say MLI was signed off on 7th June 17. Deposit of, now whatever we agree, we have to say with the third party, we have to deposit it. So it gets reflected. So 2019 June. So first entry into force for MLI is that. Entry into effect is when 2 countries effectively agree, that will be entry into effect. For India, it will be from 1st of April 2020. For the countries which have agreed, before 6 months gap they give. It's not that today you agree, then tomorrow immediately it will come into effect. They give a minimum of 6 months time. Yeah, these are all the things, flowcharts, matching database. The time is over, sir. Otherwise, I'll just show the. Thank you. If possible, matching database. That matching database, actually, they revised it in June. It is very simple now to look at. I thought I'll just show that, and with that I will stop. It has to update loading data. Where like you can choose India and then another country. Then immediately it will say this article applies, this article does not apply. So each and every article wise you can go and check it. So to that extent they have here. Albania, here you can choose India and the whichever country you want, and here it will say cover tax agree, this applies, does not apply, etc. So each thing will come. So it's rather easier to understand. So this can be the base, this one, and the synthesized DTAA. So if at all now we want to take any decision on withholding taxes to be paid or not, now these are all the things now we have to consider before giving any opinion. Thank you.
Any questions from the floor? Only 5 questions.
5 questions. I asked him so 5 to know.
Any question?
Where is the material we can get on MLI?
OECD MLI.
மூணு புக்கம் சுற்ற போறாமா பாத்துக்கோ. மூணு புக்கம் சுற்ற போறாப்ல பாத்துக்கோ.
This is actually released by BCS. 3 books they released. 1 book covers that what is MLI, the explanatory statement, all that those things and all. This I think from the time sir told I am only along with this. I am only along with this book only. And there is 2 books as explanatory for this. So 3 books totally.
Who has published that book?
BCS have done this. Bombay Chartered Accountants.
Okay.
They have done this. So this is actually helpful to go through. To understand the secondary, at least to go through. No sir. It was very good question. Actually, I should have answered, said this. Now, with how we saw earlier, the double taxation avoidance. Yes, sir. What is the question, ma'am? Whether after some time this MLI will, DTAs will vanish or not. Whether DTAs will vanish is asking. No. As with Income Tax Act, DTAA was sitting along with. Now, MLI will also sit along with. MLI says, okay, this part you have to take, that part you have to take. So, that is actually along with only. Even in that, whatever the clauses, that and all I have not taken, like it says, in place of this, you consider this. If there is, in the absence of this, you consider this. So there are so many clauses, so this will only be in addition, the DTAs will not go. We have to now read MLI also.
Sriram, any question?
Thank you very much.
Okay.
One more time.
Thank you.
Actually, I'll be very happy if there are many questions because of this only I think we will start reading it and trying to understand. So thanks a lot for the patience and for the opportunity, sir. Otherwise, I would not have done
One
this much.
information I want to share.
Yes, sir.
When I circulated the link for all the CAs and the lawyers, I received minimum 15 messages. I received back. What is MLA?
Yes, sir. No, understand, sir. Otherwise, why to look at this unless otherwise it is important, you face it. It's better to be unaware of certain things. I think this is one such thing. But
level intelligence.
and I have to thank Vasu sir also for your coordination. So thanks a lot, sir.
Yes, thank you.
Thank you very much.
I should thank Vali Madam for 2 things. One is for the wonderful presentation. And second is, we were fishing for ideas as to how to bring in more participation for the study sector. I think we'll choose a speaker who comes with question and also gives. Thank you, madam. Thank you for very nice presentation. Yes. On behalf of Revenue Bar Association, I thank Valli madam and Sir also for the wonderful presentation. I request you kindly to all of you to join for the high tea.